Looking for fresh capital right now? This company grew margins and avoided expensive lines of credit.
Welcome to Financial Modeling with Digital Assistants, a case study with Lucas Ernesto Wall.
Today, I am going to share with you how a mid-sized company navigated sudden changes in funding. The founder of a company in the health industry approached me because the leading investor decided to halt investments. The company has been growing rapidly during the last few years, but the current economic environment made the investor pause all funding. The company has achieved many milestones. It is a major success in its field and brings a lot of value to its clients. The first reaction was to call its bankers. All of them asked for up-to-date financial statements, and after a brief conversation, it became clear they were going to look for healthy margins. The founder told me she has been struggling to get insights and deep analysis from her team. This is something common. It doesn't reflect poorly on the team, actually. One thing is to set up a team to take care of routine accounting, payroll, receivables, payables, and taxes. Another thing is to dig deep into unit economics, detailed cash flows on one-time events, the impact of operations in financial results, or the impact of financial results in operations. The first step was to understand the timing and the size of the problem. The company had 90 days to find more than $125,000 per month in new funding, or better yet, produce that amount internally. We began analyzing their balance sheet, last 12 months, current assets, current liabilities, long-term assets, long-term liabilities, equity, everything. Same with the last 12 months of their income statement. Account by account, every amount was checked and inspected. We looked for variations, sudden moves, and dig deeper. We organized their P&L into a P&L with 3 different lines of business, plus a clear line showing gross margin and clearly indirect costs. It became obvious the company would save in professional fees, outside counsel hired to do non-critical legal work, without limits to hours charged. This was $30,000 per month. We still had to get another $95,000 to achieve our goal. Seeing each line of service separately allowed us to see staff's real costs. Deep and hard conversation ensued, and 2 things became obvious. First, there were unprofitable lines of business. Second, other staff categorized now as indirect costs were too high. Reducing those indirect costs provided another $50,000 per month. We still had around $45,000 more to reach our goal. But next, we did a deep-level unit economic analysis. This is a deep discussion that requires a sound understanding of the decision-making units. Why the company is paid, by clients, how clients perceive the service, followed by what it truly takes to render that exact service. We determined the true cost of an entire service team, the average number of patients seen, the cost per patient, and the price charged per visit. We estimated the margin per patient, the average number of patients seen per month, and finally estimated the expected gross margin. To increase margins, the team had to see more patients per hour, but it also needed higher capacity. So adding another technician was necessary. That would enable the team to increase the average number of patients to 6 per hour, which in turn reduced the cost of service per patient. In consequence, margin per patient increased, and the average number of patients per month had also to increase. With all changes in place, we were in a place where we passed the goal that we had. Of course, the client was very happy and gave us this testimony.
Lucas showed me my company in a way no one ever did. I spent months asking my team for actionable information, and they didn't provide what I was looking for. Lucas was able to understand what I needed, and he created the analysis I wanted to run the company the way I need. I was able to begin the company turnaround after only 2 conversations with Lucas, and I did not need external funding anymore.
I hope you have enjoyed this case study and learned a bit about what it takes to create meaningful results nowadays. Please leave your questions below and do not hesitate to contact me with any questions. The most expensive way of financing a business is by issuing equity. Every piece of the company you give, you never get back. The second most expensive is by getting commercial loans. You have to pay interest, and they are getting more expensive nowadays. The least expensive of all is by generating margins, because in essence, customers finance your growth. Sometimes business leaders tend to underprice their services. They don't realize there is way more expense required to produce a unit. That results in unit economics not rooted in real life, making the company lose money.